Let us take another example to understand deferred tax assets and liabilities in detail. This time we'll talk about the warranty expense. Now, warranty expense actually gets different kinds of treatments in the income statement for shareholders and the income statement for the tax authorities. What we report in the income statement is basically an estimate of warranty expense. So how much as a percentage of sales do you expect in a particular year? That estimate is actually reported, and this estimate can be different from what you have actually paid. So an estimate is different from paid, and it can be quite different. So what the tax authorities say here is that when you are reporting the income statement to the tax authorities, only report when it is actually paid. Okay, so reporting of warranty expense only happens when it is actually paid, and in the case of income statement for shareholders, only an estimate is being provided. So let's take an example and see what this results into. So we'll start with the sales, and we'll talk about the income statement for shareholders first. Sales, let's assume that this is 1000, and let's say that there were no other expenses but warranty expense. The only one expense, that is warranty expense. We are not considering that there was anything called cost of goods sold kind of expense, and maybe the management has provided us with an estimate that 5% of sales actually goes as warranty expense. Okay, so I'll put 5% of the sales as warranty expense. 5%. So my gross profit becomes 950, and let's assume that there are no other expenses in between. What we will have is the taxable income, or EBT. I'm assuming that there's no depreciation expense, there's no interest expense, so your EBT becomes 950, and your taxes, which we'll assume here that you are paying at the rate of 40%. So this will be 950 into 40% here, so we get this as 380. And the net income, NI, this is 950 minus 380. Okay, so this is what we get for the income statement for shareholders. Let's assume that this was year 1, and there were 2 years. So I'll just copy this and change some numbers. Let's say here it was 1500, and the warranty expense was 75, which was 5% of the sales, and all the numbers are calculated accordingly. So we have this profit as 570 and 855 here. So we are done with the 2 years of income statement for the shareholders. Let's make the income statement for the tax authorities. Now, the change that we will expect here between the income statement of shareholders and the tax authority will be only one change, and that is the warranty expense. So I'll just delete this, and I'll put in some numbers, assuming that there's a change in what we report to the tax authorities. Now, when we treat the warranty expense with respect to tax authorities, it is included only when it is paid. So warranty expense are those expenses which are used to kind of repair the faulty goods that you may have provided. So let's say that in year 1 there were no expenses altogether with respect to faulty products, but in year 2, let's assume that the overall cost was 125 with respect to the warranty expense. So now let us see what happens when we look at these two taxes. Taxes which is shown from the point of view of shareholders, and the taxes which we get from the point of view of the tax authorities. So we'll see that these numbers are different. So what does this lead to? So what we note here is that this income tax expense is 380. However, the taxes payable is 400. So we will go back to our original formula where we know that income tax expense is equal to taxes payable and plus minus your deferred tax liabilities or deferred tax assets. This is your income tax expense. Income tax expense is the one which is reported to the shareholders, and whatever is reported to the tax authority is called as taxes payables. So here what we see is that this is equal to 380 is equal to 400 plus some number. This number comes out to be 20, and since you have actually overpaid here in this situation, this will result in a form of an asset which you can take advantage of in the near future. So we'll call this as deferred tax assets. So this is about your year 1 equation. What happens to your year 2 equation? So let's go back and see how much is the tax here. In year 2, we note that the tax or the income tax expense is 570. However, your taxes payable is 550. So what we see is a situation where 570, this is equal to 550 plus some number, and this number comes out to be, deferred tax comes out to be 20 here. Now this deferred tax actually reverses out your assets which you have created in year 1. So how this is actually shown on the balance sheet, let's look at that. So here we have the balance sheet of year 1 divided into assets and liabilities. On the asset side you will find that this is DTA, deferred tax asset. This is written to an extent of 20 here. And in year 2, the assets and liabilities, your deferred tax assets, since you have underpaid and shown more, here this 20 gets reversed, so this number comes out 20 minus 20, this is equal to 0 here. So your deferred tax assets also gets reversed and it goes back to 0 here. So again this is a example of a temporary difference, because this assets and liabilities are created temporarily and it moves back to 0 over a period of time.